Welcome and thank you for joining us. You're listening to the Beyond 50 radio program. I'm Daniel Davis. On the program today, we're going to be talking about finance. In fact, probably many people are trying to figure out what's going on and whether or not we're going to be pulling out of this depression that we've been certainly feeling the great pinch of. Joining us here on the Beyond 50 radio program today is Harry S. Dent, and for the past 30 years he has used the science of demographics to predict major economic and market shifts with uncanny accuracy. He's been able to use this ahead of time. He predicted Japan's lost decade, the recession of 1990 through 92, the biggest bull market run in U.S. history, and most recently, the 2008 credit crisis and stock market crash. He now predicts an even greater crisis to come. He was on our program before as we talked about the Great Depression ahead. We're going to see if anything in store that he has to share with us today is going to be encouraging, maybe less discouraging, but we'll find out. I'd like to welcome to the Beyond 50 radio program today our guest, Harry S. Dent. Harry, thank you for joining us again here on the program today.
Oh, hi, Daniel. Nice to be back.
Now, tell us what's going on here. I mean, is it cycles? I mean, are these patterns that we tend to follow and we just kind of get ourselves into trouble, or is it just poor decisions? What's going on?
Well, you know, it's everything. I mean, it is clear cycles. Demographics is the most important cycle I discovered in the late 80s, where there's like on a 46-year lag to the birth index in the United States, which we adjust for immigration, legal and illegal. We get growing times in our economy when a generation is earning and spending more money, and then it peaks. 46 is the average, is the peak in spending of the average family in this country. And we hit, we started the last boom in 1983, right on cue, this 46-year lag, and we peaked in 2007, right on cue. That's a 46-year lag to the peak of the baby boom births in 1961, and we started to go down and slow down, and then it became obvious how bad the subprime crisis was and how much debt we had and how much overvalued home prices and all this other stuff. So part of it is cycles, like you say, and measurable in demographics. Part of it is poor decisions. I mean, I could spend an hour going through all and David Stockman just spent 718 pages in his new book, The Great Deflation, going through all the financial decisions our governments and banks and consumers have made, in the last several decades that led up to this unprecedented bubble in debt. I mean, we have now more than 8 times debt to GDP when you count entitlements like Social Security and Medicare. It was 2 times GDP before we had the debt bubble burst in 1929 that led to the Great Depression. So now what's really happened since, and it's very simple, governments for the first time in history say, we will do anything. We'll throw the kitchen sink. It's been over $10 trillion in quantitative easing around the world, trillions of dollars of bailouts and all this sort of stuff. Governments have said, we just won't let debt deleverage. We won't let this huge bubble turn into a downturn. And you know what? That's the worst thing, Daniel, you could possibly do. They're killing the golden goose. They're stopping the free market system that knows how to rebalance and heal itself, just like our bodies do. They're stopping it from doing this, and I'll tell you what you get. If you do that, you get the same thing Japan's gotten. Yeah, they had a lost decade, a 14-year downturn we were predicting in 1989 just due to demographics. Well, now they're in a 23-year downturn that they're only starting to recover from through unbelievably extreme stimulus out of desperation because they're in a coma economy. 0 GDP growth, 0 inflation for 20 years now. You basically kill innovation, kill the economy's ability to rebalance, and you end up in a stimulus economy that just barely survives, like in an emergency room in a coma. So this is not encouraging to me, and I think in the United States, I think we're going to lose control. I think China's bubble's about to burst. Spain's depression and real estate bubble is getting worse. Greece needs another bailout. They were supposed to have enough bailouts to last until 2020. They already need a third bailout now, and fourth, counting the debt forgiveness. I mean, so I think we're getting to the point that stimulus just kind of stops working, and I think January to June next year is the real danger period. If we're going to see another stock crash start, it's going to start somewhere, and if we don't see something by then I'll back off and say, hey, maybe things won't be that bad for a while. But you don't get something for nothing here, and the governments have done nothing to solve the real problems. All they've done is throw money in to keep the banks from failing. It hasn't helped Main Street. It's only helped Wall Street, the same people who benefited from the bubble and caused the bubble in the first place. And I think this is the worst financial policies in history, and they will not stand.
You know, you take a look at money in its essence, and really all it is a piece of paper that basically says you're guaranteed something that you want in the future. So really what it comes down to is that it is, in essence, a way that a person gives you their word, but they really don't have to be bound to buy it. You know, they can take this and they can go to somebody else who will say, I will give you my word in exchange for that dollar, for instance. And you take a look at this great illusion that we've created, and you kind of wonder, you know, can't we get it together, I guess?
Well, you know, you really can't. I mean, I always say, you know, if you don't want a hangover, don't drink a bottle of bourbon, you know. and we did that. I mean, when I look at this debt bubble, and I've studied every major debt bubble in history, you know, for hundreds of years back, real estate, commodities, stocks, you know, everything, they're always fueled by debt growing much faster than the economy, and then that debt goes into financial assets and bids them up, and then everything gets in a bubble, and then everybody overexpands, businesses and consumers. Consumers bought way more real estate than they could afford. Businesses invested in capacity more than they needed. In China, it's off the charts, the overinvestment in real estate and industrial capacity. It's outright scary. I think China is going to be the biggest disaster of this century when things finally come down. And so the economy has to go down, and that debt has to deleverage. These financial assets have to come down to reality if the next generation's ever going to be able to afford a house again. High home prices are not good for the economy, period. They're good for the people who already bought them. Or invested, but it's not good for the economy because it raises the cost of living, raises the cost of business, makes everybody uncompetitive. I mean, I was in California before Florida, and there, I mean, a starter home in San Francisco was $800,000. What young family with an income of $30,000 can afford an $800,000 house? And if they do, what else do they have left to spend their money on? So these bubbles do get out of control. Once it happens, there's nothing you can do but let the debt deleverage. The government can make it more civilized. You can do it more like Chapter 11 in business and just kind of restructure debt. But you have to restructure these debts, and the government's not doing this. The government is adding more debt as the solution to the debt crisis, keeping the bubble going, which affects the wealthy in Wall Street more than anybody. Doesn't help Homer Simpson much. And at least wealthy people are still spending money, the top 20% of households that have 3.5% unemployment, and they barely keep the economy growing at 2%. But think about this, Daniel. We're getting 2% GDP growth on average, anywhere between 0 and 4% in these stimulus cycles before they fade. But it's only creating $350 billion a year on average in GDP. $2 trillion a year in stimulus to create $350 billion a year, low growth rates of GDP. Now, how bad would our economy be without this $2 trillion in stimulus? And it's $1 trillion in fiscal deficits on average and $1 trillion in quantitative easing of money. I mean, we're in bubble land. Anybody looks at the facts here, it's like we would be in a depression if it weren't for this stimulus. And how long can you keep a debt economy going on stimulus unless you restructure this massive debt and take a huge cash flow burden off of the private sector, and we're not doing that.
Now, okay, let's go ahead and follow this and see what the actual solution is compared to what we tend to hear, through the media, what we tend to read in newspapers, what these expert economists tell us, but it just doesn't seem to be the truth.
Yeah, I mean, I hate to say it, economists don't know their ass from a hole in the wall. I'm serious about this.
Well, you don't have to say it's true.
Yeah, it's true. They think the economy should be a machine, and it should never have a recession, never slow down, never balance out stuff. I mean, they just think you can run this at 4% a year GDP growth and 2% inflation forever. It's such a misunderstanding that it says to me they don't understand anything about the economy. They understand stuff about it, but they don't understand the dynamics of the free market capitalist system, which in cahoots with democracy, which is really socialism and the opposite principle to balance it out, has been the greatest innovation in economics in history. And now they're willing to kill this golden goose just so we don't have to go through some pain. The solution is simple. We went just from 2000 to 2008, and that's under a Republican president and Congress, went from 20 to 42 trillion in private debt, and we went from 5 to 10 trillion in federal government debt. But the biggest debt bubble was in the private sector. We were the drunken sailors, even more than the government. You have to restructure that 42 trillion debt back to pre-bubble prices. Home prices have to go back to pre-bubble levels. We're not there yet. Home prices have to fall 55% from the top in early 2006, and we've only been down 34% at worth, and now we're down about maybe 29%. We have not balanced out this bubble, and then there's many other bubbles and stuff, but it takes a downturn, and the government could actually be active in this. The government could say, instead of we're going to give trillions of dollars to the banking system for free just to keep them from failing and cover their loan losses and keep them alive and allow them to speculate. Now, is that a good solution? Have all our banks speculating at 30-to-1 leverage? That's what they're encouraging. Instead, we're going to require you to write down loans to market value, and we're only going to give limited assistance to the banks that actually write down loans. In other words, for every $1 a bank writes down, maybe the government covers 25 cents of it, just to keep the banking system from totally melting down and to favor the best banks. But if we don't write down this debt, and Japan has not done this in 20 years, we're going to be in a coma economy like Japan. Japan's been growing at 0%. Maybe we grow at 1 to 2% because we have better demographics than them, but our demographics don't turn up until 2023 or 24. And Japan's turned up back in 2003, and they still haven't been able to recover because they never dealt with the real problem, which is excessive debt and leverage. You got to flush it out of the system, just like the body would do if you ate bad sushi. The next day or morning, you would flush stuff out. That's what the economy started to do in 2008 and 9. The government says, no, we're just not going to let this happen. We're not going to accept the consequences of $42 trillion in debt. That's how money's created. The Federal Reserve does not create much of the money in the economy, but it allows to be created through the banking fractional reserve system and the shadow banking system now that Wall Street innovated to create even more money. We went nuts. Debt grew at 2.7 times GDP for the whole boom from 1983 to 2008. How could any economist not warn that that's going to be a problem? If you're an economist and you see that happening and you don't see it as a problem, then you don't know crap about anything.
Mm-hmm. You know, you take a look, too, and there was a lot of the problems that I believe that were also created through the deregulation of the banking system. You know, back after the 1930s, banks were heavily regulated about how they could actually put, I guess you could call it, people who had saved money, who had invested money within banks. They had to be very careful with being able to take this money and put it out there and how it was used. But, you know, starting with the Reagan administration, to my understanding, it could have even been before that, but around the Ronald Reagan administration, they began heavily deregulating banks and putting money out there at tremendous risk. So here you got this poor guy who's got an IRA, for instance. He's doing what he was told was the right thing, what was the safe thing to do, which a lot of investors, when they actually put money out there to invest for their future, look for safety. They look for something that can more or less be guaranteed. Then all of a sudden, you deregulate that, and a bank is allowed to take that money that's sitting in their coffers, give it out to somebody who is highly a risk or has risky behavior, and then it vanishes in the wind, and he turns back to Joe Saver and says, sorry about your luck. You know, we gambled, we lost, and there's nothing you can do about it. And I think that's also the problem. What do you think about, you know, the government stepping in and regulating? It seems that they're kind of, you know, in it together. And my understanding is that, for instance, the government says this is really what we want you to do, and the banks and Wall Street were just able to carry it out. I mean, who do you point the finger at here?
Well, you know, it's everybody. Consumers and businesses overborrowed, took advantage. I mean, you got soccer moms hawking their home to get their kids in a private school, for crying out loud.
Right.
But the banks did all this stuff. They merged with investment banks, and that got allowed in the 1990s with Bill Clinton, I mean, what happens is, after the 20s bust in the 30s, all these regulations were put in, but you get 2 generations later, everybody's forgotten, so they loosen everything up. But the biggest thing started with the Fed. The Fed just started saying, especially in 1987 crash, we're not going to let the stock market go down. Every time there's a financial problem, every time a hedge fund goes bust, every time a major institution goes bust, every time the stock market crashes more than 20%, we're going to come in and throw money in the economy and keep things from going down because they realized this wealth effect was important. So the Fed pushed interest rates too low. That causes speculation. That causes banks and investment banks to lever up and do all types of crazy stuff. And then they made loans cheaper to consumers by the government guaranteeing these loans. The government's going to guarantee almost every mortgage in the country through Fannie Mae and Freddie Mac and FHA. I mean, this is crazy stuff. And when you do that, people overborrow. Banks don't care about lending standards anymore. Real estate never goes down. The government's not going to let it go down. The government's not going to let stocks go down. So all these investment banks and hedge funds over-speculate, and the whole place goes nuts. The government is the biggest driver of this, but everybody is guilty. The banking system, the consumer, businesses, everybody joined this bubble, and nobody wants to see it end.
I think, too, one of the scariest things, Harry, that I'm beginning to see, and I just recently read that California is about to really throw it into the air, is minimum wage. Now, I remember when I got my first job, minimum wage for it seemed almost a decade was, below, I think it was $2.50 an hour. And then finally, when I got my first wage job, that I think I was at about $2.75, $2.80 an hour, and then it finally bumped up about a quarter. And as far as I can remember, it stayed that way for another 7 years. And now you're seeing it almost yearly, going up by as much as $1. And I'm sure the minimum wage workers are thinking to themselves, well, this is great, but they don't realize that most minimum wage jobs are in the basic, I guess, commodities, if you will, that people buy. You go to a Subway sandwich, and now a sandwich is almost $7. What do you say to something like that, the minimum wage thing?
Well, again, same thing. Everybody talks free markets. Nobody wants free markets. Everybody wants to regulate everything and force stuff. And, you got to let the markets work. I mean, the truth is, starting especially in the mid-'90s, we had this assault on American wages from Asia, especially China. China moving people, low-skilled, low-wage people from rural areas, putting them in factories, pegging their currency 60% below ours, which is cheating, and which Japan and Korea have done for decades. And it did put downward pressures. While the wages of the top 10 to 20% have gone up dramatically in the last few decades, since 2000, the wages of the everyday person's gone down. So first of all, you got to adjust those minimum wages by inflation to see what the real growth is, and it's not going to be as much as you think when that happens. In fact, those people have been falling behind. But the point is, let the damn economy do its thing. If there's too much demand for loans or commodities or anything else, and the price goes up, and that puts a limit on it and forces innovation, forces rebalancing. Let the economy take a breather every now and then and decline. Let debt deleverage. Governments aren't allowing the free markets to work, so you get all these imbalances build up, and you never correct them, and then what it ends up like in the 1930s, you got to remember the Fed was invented in 1913, and they came along to reduce interest rate cycles that were extreme back in the late 1800s, early 1900s. Well, what they did was they smoothed out the economy, kept it from rebalancing, and then what you ended up having is the biggest rebalancing, the biggest downturn in history in the 1930s. The Fed, by not allowing the markets to work, by constantly rigging it, constantly, intervening, made it worse. Let the damn economy do what it does. Let it work. And means we got to take a little pain at time, and some people may have their wages hit, but if you pretend like it didn't happen, or if you pretend like this debt didn't happen, or this Asian wage deflation didn't happen in the United States, then you're in denial, and you're basically, the economy is going to basically give you a huge lesson.
Harry, it was interesting as you were saying that. I was thinking about the laws of nature, especially when you have forest fires. People, that's a bad thing. But the fact is, that's a natural law in motion that actually helps the forest become stronger and more vibrant than it was before. It cleans out all the dead stuff,
Exactly.
so to speak. And it sounds to me like the economy has a natural law in and of itself.
No, it absolutely does, and that's why the free markets are so good. But, I mean, even I'm a free market guy, but I also say at the same time, free markets have to have rules. Otherwise, the cheaters win. And that's what's happened. The rules, as you said, were taken off of Wall Street, and Wall Street and the banking system rigged this system with unbelievable debt and risk, while at the same time telling people, oh, no, we've diversified all this stuff. Oh, no, we're insuring all this stuff with credit default swap. Credit default swaps are BS.
Right.
They're no insurance. It's just speculation. It's like the Speculators Insurance Company of America or something. They're saying all these risks were insured by credit default swap. These are just gamblers making leverage bets. This isn't insurance with collateral. So they tricked the nation into saying everything's okay. We can give you a 6% yield with no risk now that Treasury bonds have been pushed down by the government. And that's how we got all these toxic securities, and that's how we made all these bad mortgage loans to people who couldn't afford houses. So what's happened? The economy's taken home ownership from 69% back down to, I think, 64 and falling. But the truth is it probably should be at 60%. That's a better long-term average. That's the people that can really afford a home, and people that don't have the steadiness of income, can't bring up a down payment, shouldn't own a home. It's that simple. The markets wouldn't allow it, but they rigged the system. The government and Wall Street have basically worked together to create this great bubble, and it's going to burst. It started to burst in 2008. They stopped it, but you can only stop it so long. I think the next bubble burst hits in 2014.
So it sounds a little discouraging for our future.
Yeah. Again, if we had restructured a lot of debt, we let a little bit of private debt deleverage, mostly in 2008 at the worst of the crisis, but government debt's gone higher. Japan, over the last 23 years, has barely let private debt deleverage, and their government debt's gone from 60% of GDP to 250%, and it's rising. I mean, how can that work long term?
Mm-hmm. So what do you suggest for our listeners out there to do as far as prepare themselves for what's inevitable?
Well, it's real simple. I mean, you can't avoid the markets altogether because the governments are rigging them to go up. And even in the Great Depression, the markets went up more years than down. But in the downturn, since they're so violent, they were worse. So I say think like a long-term trader. You can't buy and hold anymore. We've seen things bubble back up. The government's pushed this probably about as far as they can. I think the Dow's going to go to 16,000 or a little higher in the next several months, and then I think we're going to see the next crash. We've got a pattern of stock prices on each bubble going to higher highs and in a trend line, and then in each crash going to lower lows. So I see a Dow of 16,000 plus or minus, and then a Dow of 6,000 plus or minus, all in the next several years. So you got to get defensive while things are good. And like I say, you can't be out of the markets all the time. I'm telling people just be safe from January to June of next year. Sell your stocks, sell any real estate you don't need. Get in just safe stuff. Don't look to make money. If you're more aggressive, you can bet on stocks going down, or you can buy the U.S. dollar index. UUP is an ETF for that. The dollar index is the ultimate safe haven. The last time we had a crash in late 2008, gold went down, silver went down, commodities went down, real estate, all these hard assets went down. U.S. dollar went up. We're the safe haven in the world, and the U.S. dollar benefits from deleveraging. So get safe for the first half of next year. If we start to crash, stay safe for a few years until it works out. Then I think sometime in 2015 or so, you'll be able to buy stocks again. But wait until they're down, and especially if we see new lows. When you start to see new lows, we see the Dow near 6,000, that's a time to buy again.
Mm-hmm. And it's pretty simple, but you also hear a lot of, I don't know if it's speculation, about how in world currency that other nations want to pull away from the U.S. dollar. What are your thoughts on that?
Well, again, that's a theory, and it's baloney. The same people say that, dollar's going to go to zero and gold's going to go to 5,000. How's gold doing? We told people gold's going to go down when people realize that even with massive stimulus, you're not going to get much inflation. And in a downturn, We're going to see deflation. Gold's an inflation hedge. The U.S. dollar, more U.S. dollars were created than any currency in the world in the bubble, and you got created through all this debt and leverage. When the bubble deleverages, you're destroying dollars, so the paradox is you're destroying dollars and making them more valuable. That's why they go up. But also, we're the largest country in the world. China's going to look so unstable, it's going to be unbelievable when their bubble bursts. And Europe's been a basket case now for years. We're still the best house in a bad neighborhood, and we're still the largest economy in the world. So the dollar goes up. People talk about using other currencies. It would be impractical to use other currencies. And nobody wants China, Germany, Europe. These are export nations. We're not big exporters in the U.S. Nobody wants their dollar to become the reserve currency and then to be revalued upward. Germany's supporting a dead euro just because it doesn't want its currency to appreciate if countries were to back out or it were to back out, and it would kill its exports. Exports are 35% of Germany's economy. They're 35 to 40% of China's economy. These countries can't afford to be the reserve currency, even if the world would let them. So this is a great theory, nothing behind it. And we say dollars going up, gold's going down. So that gold is not the way to protect yourself. That's the biggest message we have. That's the one thing people can't get. But again, I say, forget what I'm saying. Look at the last crash. Gold went up in anticipation of in the early stages, but when the crap hit the fan, gold went down. Gold's going down right now as well.
Harry, tell us about your newest book and how our listeners can come to find it.
Yeah, well, I got a new book coming out on January 7th, 2014, so just a few months away. It's called The Demographic Cliff: How to Survive and Prosper in the Great Deflation of 2014 to 19. And in between now and then, we've got a great free daily newsletter called Survive and Prosper, and you can get that, sign up for that with just your email address at www.harrydent.com.
As I listen to, and I'm sure our listeners perhaps feel the same way, I mean, there's so misinformation about what's really going on here, and it can sound very discouraging. But as I've had you on the program before and even today, it sounds to me like if you really just get a grasp on what's going on and you understand, how to roll with the punches, so to speak, you can actually come out of this whole thing pretty okay. You might get a little bruised, but you can come out of this whole thing pretty okay.
Well, more than okay. General Motors passed all of its competitors in General Electric in the early 30s because its competitors went under and they survived. Joseph Kennedy and people like that sold at the top of the bubble and then rebought 80% lower. How could you make more money than that? Something's $1 today and it's 20 cents tomorrow. I mean, it's the greatest sale in history. That's what deflation is.
Right.
It's a once-in-a-lifetime opportunity to buy real estate, beachfront property, stocks, companies, gold, commodities, anything you want in life at 20, 30, 40 cents on the dollar, once in a lifetime. So it's an opportunity from my point of view, but you will get bruised if you don't see it coming, and most people got severely bruised in 2008.
Very encouraging. Harry, thank you so much for joining us here on the program. Before you go, give our listeners your website.
www.hsdent.com.
Very good. We welcome you to come back on the program again when your book comes out, and we'll talk more about this.
Okay, great.
Thank you so much. We want to thank you, the listeners out there, for tuning in. This is the Beyond 50 radio program. I'm Daniel Davis, and remember, live your day past halfway.